Hey, good morning, Liba.
Good morning. How are you?
Pretty good. Just a little bit late getting in here. I Let me just move over to a more well-lit area so I can see what
Okay.
I'm doing. So, you go there. 30 seconds. Okay, getting set up here. I'm sorry for that. You can hear me, Liba?
Yes, I can hear you now.
Okay. Let me just turn the cell phone off. Okay. Now dig up the PowerPoint. How did you do on your first test?
I did okay.
Just okay? What
I
did
got
you
a
get?
B.
A B? Oh, come on, we
A
can do
B
better.
plus.
There you go. Now you're talking. There you go. Excellent. What kind of problems gave you a hard time? Anything in particular?
Calculating.
Oh, God, yeah.
That was hard. Those questions were hard. The multiple choice ones weren't that bad.
Yeah. Okay. Just having trouble finding the PowerPoint, but we'll have it in a second here. This is class 66633. 66663. All right. How do you like the class so far?
I like I really like the class. It's different from what I'm used to, political science classes and psychology classes.
Yeah, boy, totally different world, huh?
It's totally different.
Yeah.
Understanding the concepts and it's different, but I like it. It's very useful and helpful for the real world.
Oh, yeah. Most importantly, it'll be helpful for when you get into accounting 230. You know your debits and credits. Some of the students who take accounting 230 LIBA don't take 110. And they start off at a disadvantage. This thing is giving me a hard time. I don't know what's going on here. This site can't be reached. No internet. Are you still there, Liba?
Yes, I'm here.
It's telling me I don't have the internet. So hold on. We want to go down to chapter 5. Oh boy. Chapter 5. Okay. Looks like we're getting there. Okay. Come on. Go. There we go. Hey, Liba, let's hook us up here. Okay, you can see the PowerPoint now?
Yes, I can.
Okay, this chapter is a little more complicated. It talks about two different methods of doing things, and it kind of bounces back and forth between the two, but we'll get through it. Nothing too tough. Wow, look at all these learning objectives, huh? Holy cow. Perpetual system, periodic system. So let's get going. Merchandising operations. Now we're getting involved with the merchandising operation, Liba. Early in the book, we were doing Mitchell Williams pizza deliveries, right? Everything was a delivery. Here, we're going to have inventory to worry about, merchandising, like a wholesaler, like Office Depot. Measuring income for a merchandise company. Think of us as Nordstrom's, okay? We're introducing something here. We have our sales, and then we subtract cost of goods sold. Cost of goods sold. Cost of goods sold is the total cost of merchandise sold during the period. You at Nordstrom's bought a garment for $1,000. You bought a nice dress for $1,000. You sold the dress for $3,000. The $3,000 is the sales revenue. The $1,000 is the cost of goods sold, okay? So the cost of goods sold is what you paid for the garment you sold. You subtract out to get what's called gross profit, and then we're going to subtract operating expenses and net income. So you're looking at a little different income statement now, a little more complexity. The operating cycle, we know about that, the flow of costs. This is an important little concept to grasp, Liba, and everybody. The flow of costs in the systems. You have a beginning inventory, plus you purchase things. Your beginning inventory plus all your purchases can be called something called cost of goods available for sale. If your store had 1,000 books in it at the beginning of the month, and then at the end of the month, by the end of the month, you bought in 9,000 more, that's 10,000 books you had available. Well, what's available at the end of the month can only be in two places. You've either sold them or you still have them in the inventory. All right. Let's talk about a perpetual inventory system, which is what most companies use these days. It maintains detailed records of the cost of each purchase and sale. It maintains inventory records such that inventory that should be on hand is continuously updated, and it determines the cost of goods sold each time a sale occurs. In other words, what we're saying here, under a perpetual system, when you record your sale, you are recording both the sales piece of it and the cost of goods sold, which is different from another system. Perpetual inventory system, you know every minute of every day exactly how much inventory you have on hand. So if somebody calls up your store and says, I'd like to buy 5 of these items, you don't have to run in the back and look to see if you have them. Your perpetual inventory system will tell you, as long as you're keeping it up correctly. The periodic system is different. It does not keep detailed records of the goods on hand. You get the cost of goods sold only by counting it at the end of the month. The month end comes, you have no records of cost of goods sold under this method, believe it or not. Determines cost of goods sold by account. And it calculates it with this little formula here. The beginning inventory plus your net purchases equals available for sale. You go out in this factory storeroom or whatever, the storeroom warehouse, you count the ending inventory, subtract out, and you've got cost of goods sold of $775,000, okay? So under the perpetual system, you never have to count. Once in a while you might want to. Perpetual system, you don't count. Periodic, you're forced to count at the end of the month. Back to the period, to the perpetual, what's advantage of it? It's used for merchandise with high unit values. It shows the quantity and cost of inventory that should be on hand at any time. And it gives you great control over inventories, much better than a periodic system. You always know what you have. Indicate whether the following statements are true or false. If false, indicate that to correct the statement. So let's just look at them real quick. The primary source of revenue for merchandising results from performing services. No. Merchandise means you're buying and selling things. And they talk about the operating cycle is shorter than the of a service company, shorter. I don't know about that. Sales revenue less cost of goods sold equals gross profit. You have to know that like the back of your hand, and you will. And I'm not going to go over another false one. Record purchases under a perpetual system. Perpetual. Remember, in this chapter, we're talking two systems, perpetual, periodic. Purchases are recorded using cash or credit, normally recorded when the goods are received from the seller. And the purchase invoice should support each credit purchase. So there's a purchase invoice. They spent some money with this guy, or they're going to. So there you go. You debit inventory and you credit accounts payable. That's not too tough to remember. Under the perpetual inventory system, you debit inventory, credit accounts payable. Let's talk about freight costs. Freight, that's the cost of the truck bringing the goods into you. It's the UPS charge you might get hit with, the FedEx charge. This is the cost of bringing the goods from the seller to the buyer. And as such, they get included in your cost of goods sold calculation. Ownership will pass from buyer to seller, or seller to buyer, in different ways. Let's briefly talk about something called FOB, freight on board, okay? Freight on board, free on board. There are two we're going to talk about, FOB, shipping point, and freight on board, destination. The FOB point is simply the point in time where title to the goods changed hands. So you're looking at FOB shipping point. What that means is as soon as that truck pulls away from the parking lot at the seller's store, the buyer owns the goods. The buyer is responsible for the freight. The buyer is responsible for any insurance or any problems that come up. FOB shipping point. Then you have FOB destination, which means that the seller owns the goods until they arrive at the destination. And at that point, title changes hands. Does that make sense to you, Liba, the FOB?
Yes.
Yeah, it's an important little concept, I think. Okay. Assume we have freight here. We had our let me just look at this real quick. Assume upon delivery of the goods, stock payer pays public freight charges. Okay. All right, here we go. What they're saying here is you might get a freight bill from the common carrier. In other words, the way it would be set up is we'll ship the goods to you, and then I'm going to hire a freight guy, and the freight guy is going to bill you. So in the first one where you're debiting inventory and cash, you're debiting inventory for the freight charges. Freight charges become part of delivery, okay? In the bottom one, they're just showing you that the guy shipping it is paying freight out. That's a lousy slide. I like to get rid of that slide. Purchase returns and allowances. Say hello to a couple of contra purchase accounts. Contra purchase accounts. Purchaser may be dissatisfied because the goods are damaged or defective, of inferior quality, or don't meet spec. Well, the buyer has some recourses. He or she can return the goods. So that's called a purchase return. You return the goods for credit if the sale was made on credit, or for a cash refund if it had been a cash deal. Purchase allowance. You may choose to keep the merchandise if the seller will give you a price reduction. Purchase return. You bought a fancy grill, outdoor grill, and you don't like it. You bring it back to the Nordstrom's or whatever store, to Costco, and you tell them you don't like it. You want your money back. That's a purchase return. Purchase allowance. You do the same thing, but Nordstrom says, "How about we knock $50 off the price and you keep it?" That would be a purchase allowance. Recording purchase allowances. Now remember, by definition, a purchase allowance reduces accounts payable. We returned goods costing $300 to pay off PPW. So you debit accounts payable because you no longer owe the $300, and you credit the inventory. You reduce the accounts payable with a debit. You reduce the inventory with a credit. Question on purchase returns and allowances. A return of defective merchandise better be inventory. What do we credit? We credit the inventory. Purchase is the control account. Let me say it this way. Purchase returns and purchase allowances are what are called contra purchase accounts. Remember drawing, when we had drawing, and that was the opposite control for equity? This is the same thing. Purchases have a normal debit, purchases have a normal debit balance, and to reduce them, we're not going to touch purchases. We're going to credit purchase returns and purchase allowances. You never credit purchases. Never. You never credit purchases, and you never debit sales. Just remember that. Nature of purchase discounts. Credit terms may be a certain discount. Okay, Libby, here we're getting into another new area. A company may issue discounts to their customers if they pay early. They encourage their people to pay early. These are called cash discounts, okay? Cash discount if you're on the buying side, sales discount if you're on the selling side. The important thing is to understand how to read it. For example, credit terms may read 210 net 30. What that means is you get a 2% discount if you pay the bill within 10 days. Otherwise, you pay the net amount in 30 days, okay? Let's look at some of the others. There's 2% 10 net 30. That's a common one. 2% discount if paid within 10 days. Otherwise, the net amount is due in 30. 1% end of month. Net 10 end of month. So you can have all kinds of different ones. You could have 1% net 45 or 3% 30 net 60. You get the idea. Now, how do we account for a purchase discount? Well, what's happened here? Suck Studio pays the balance of the bill, less purchase returns of 300, the last day of the period. Prepare the entry to record the payment. If you remember, Suck got a $300 purchase allowance or purchase return, okay? So that means they owe $3,500. Let's see now, $3,500. And on May 14th, the last day of the discount period, yeah, they paid the bill in time to get the discount. So they're going to take off 2% of $3,500. And that's going to be called a purchase discount. In the period, in the perpetual system, which is what we're working on now, they don't use the word purchase returns. They call it part of the inventory. And that's a little tricky difference between the two methods. And you just have to do a couple of problems and you'll see that difference pretty clearly. So what happened here was this company owed $3,500. They don't owe $3,500 anymore. They owe zero because they paid cash of $34.30 and they got a 2% discount of $70. What if they didn't take the discount? What would the journal entry be? Well, it wouldn't be that. That should say 3,500 and credit inventory for 3,500. That's a misprint. What if you did not take the discount? Interest rates are at a very record low right now, even though we do have some inflation coming back into the economy. Interest rates are kind of low, but now they're getting a little higher. What was, say, a 1% was maybe 2% now. So let's look at this. Here's a discount of 2% on $3,500. If it's 2% 10, net 30, it means you gave up your money for 20 days, okay? 2% 10, net 30 means you gave up your money 20 days early. That's investing it 20 days early. So you save $50.82. If you take the $3,500 times the 36.5%, which is the 2% over 20, and divide it by a year, you're going to have a $70 return. The annual rate is actually 37%, actually 36.5%. Let me see if I can say this more clearly. That's very clunky the way they do it. You have 2% discount. So you're going to take 2% from 100. That gives you 98 over 100. 98 over 100. And then you're going to multiply that by the amount that you're getting the discount, and then divide that by 365. It's a big number. So summary of purchasing transactions. Purchases and freight in or the debits, returns and discounts or credits. You never credit purchases, never credit purchases. What you do credit are the contra accounts, returns and discounts. And they're going over a few transactions here. De La Hoya buys merchandise on account from Diaz. The purchase price is $1,500, and then he returns some stuff, huh? Well, the first one, there's a simple purchase: debit inventory, credit accounts payable. This $200 item is broken. We got to return it. We debit accounts payable and credit inventory. Sales under a perpetual system. Sales may be made for credit or cash. Sales revenues recorded when the obligation satisfied. We know these things because we know that revenues, expenses, and all activities are recorded at the time they take place. And when you sell something to your customer, there's usually an invoice involved. And look at your journal entries here. We just sold something. We sold something for $100 in this example, let's pretend. We debited accounts receivable and we credit sales revenue for $100, okay? We paid $30 for that item a couple months ago. Now we're selling it. So now we record the cost of goods sold with a debit and we credit the inventory for $30. So in that transaction, we made a profit of gross profit of $70. And they're just giving you another example here. PW Audio records the sale of $3,800 on account, and nobody had money, so we know there's no cash. And on account means it's going to be accounts payable or accounts receivable. And this is clearly going to be Mr. Accounts Receivable. We're on the selling side. We debit accounts receivable. We credit sales. We debit cost of goods sold. We credit inventory. Sales returns and allowances. Well, it's the flip side of purchase returns allowance. It's the other side of the coin. We're going to use contra revenue accounts, contra revenue sales accounts. Sales revenue is not ever debited because it would obscure the performance of sales returns and cause all kinds of distortions. So what we were calling a purchase return under the periodic system, under the perpetual system here, hold on a second. What we were calling a purchase return, now we're on the other side of the fence. We're selling something. So we're going to debit sales returns when we return something. Debit sales returns and allowances, credit accounts receivable. Then we record the inventory back, 140, 140. So what's happened here? We sold something for $300, right? We had originally paid paid 100, excuse me, and $40 for the object. We returned the goods. Well, we get to reduce our sales by $300 because you never debit sales. You never debit sales. You credit accounts receivable, but now we put the $140 back in our inventory, okay? And there's the same exact journal entry, assuming the returns were effective. Here, they're just calling it a purchase allowance, I guess. The cost of goods sold is determined and recorded each time a sale occurs in a perpetual inventory system. That's the key difference between the perpetual and the periodic, that the cost of goods sold is recorded every time a sale takes place. Sales discounts, we're back to our 2% 10 again, okay? Here, we're not calling them purchase discounts, we're calling them sales discounts because we're on the other side of the coin. Recording a sales discount. SOC paid the balance of the $3,500 in time. So we received the money now. Now we received the money. We're PW Auto. We're the ones who did the selling. Excuse me. So we're going to get rid of accounts payable, accounts receivable, right? We don't know that. They don't owe us that money anymore. And they took a $70 discount, 2% of $3,500. 2 times 35 is 70, which means $3,430. $3,430 was enough to settle the payment of $3,500. Why do companies give these discounts out? Why would they give money away like this? Well, it is to encourage early payment. Some companies feel it's a good idea, that it gets customers in a good habit of paying early, but it's very costly, like you saw. A 2% discount is about 37% a year, which is a killer. De La Hoya bought merchandise from Uno. Okay, they bought merchandise. So Uno is the seller. The selling price of the goods was $800, and then they returned with a selling price of $200 and a fair value of $30. Return the sale on, record the sale. Okay, I'm making it too hard. The selling price was $1,500. That's all we do. We debit accounts receivable, we credit sales, $1,500. The cost of goods to Diaz, though, was $800. So we have to debit cost of goods sold for $800 and credit inventory. Let's worry about the return, okay? We are the ones, our customer is returning something to us. They're returning an item, we charge them $200. $200, we debit sales, returns, and allowances to reduce sales, because you never debit sales, never. You credit accounts receivable, and now we have $30 worth of inventory back in our storeroom. Stuff was in good shape, it can be sold again. We're going to debit inventory, credit cost of goods sold. The multi-step income statement, huh? What we've been looking at so far is a very simple looking income statement and balance sheet. So let's see what we have here. The single step income statement is kind of what we've been working with. You just subtract all the expenses from the revenue, and you got basically two categories, revenues and expenses. And two reasons for using it: it's simple, easy to read. You don't have any ancillary type things. So there's a single step. And like they said, under a single step, you have revenues, expenses, net income. Notice that cost of goods sold is your first expense, okay? Let's see what we're talking about with the multi-step. We're going to show three new things. We're going to show gross profit, we're going to show operating income, and net income. So look at the difference. It's the same information. It's the same information. The profit is still 38,275, but notice the presentation has changed. It's elongated because we're going to recognize something called gross profit. Net sales minus cost of goods sold equals gross profit. Gross profit. And from gross profit, we're going to subtract what are called operating expenses. These are your selling and administrative expenses. These are all the expenses needed to sell your product, to keep the business going, to pay the bills, to keep the offices supplied. So when we take gross profit minus total operating expenses, that gives us the income from operations. So this company made operating income of $181,000 on sales of about 2.6 million. So that's pretty darn good return, I would say. That's 181 divided by 12. That's about 15%. That's not too bad. Let's go down here now. After operating expenses, we come up with the following. We come up with other items. Other items are typically income taxes, interest expense, interest income, things that have nothing to do with the operation of the business, but are expenses we incurred in the world of borrowing or financing or something like that. So income from operations. So if somebody was looking at this company, after we subtract the other expenses, we come to net income and after taxes. If someone was looking at this company, they look at the bottom line, they'd say, well, they did 38275 on sales of 2,557,000, but their eye would quickly go up to the operating income, where they made 181. They made 181,000 operating income. That means the money they made by selling their product. That's what, 181? Yeah, 181 divided by 2,557. 181. Oh my goodness, I can't do this really. 1 divided by 2. Yeah, they made it. I said 15%. They made about a 7% return. And they're just showing you the multiple step income statement again, Liba. What they're going to do now is just highlight each page. Sales, gross profit, sales minus cost of goods sold equals gross profit. These are the steps. Then you're going to have operating expenses, the normal costs of business, and then your non-operating activities bring you down to your net income, okay? What are some non-operating activities? Revenues, expenses, gains, and losses unrelated to the company's main line of business of operations. Examples include interest revenue, dividend revenue, rent revenue, gain from selling property, interest expense, blah, blah, blah. Coca-Cola, my favorite whiskey in the morning. Coca-Cola's, their operation is buying raw materials to make soda, okay? That's operating. But Coca-Cola may borrow money to build a new factory in China someplace. Those costs, those expenses would be non-operating. They have nothing to do with running the business. Then finally, net income on the multi-step. The multi-step income statement for merchandise shows each of the following except what? Except what? Better be, if there's a God in heaven, the answer is D, huh? Investing activities section. It shows gross profit, cost of goods sold, and the sales. Comprehensive income statement. Items included in comprehensive income are either reported in a combined statement of net income or a separate comprehensive income statement. Here, they're talking about income that's other unrealized holding gain on investment securities. We're not going to get too involved with that. Let's see what we have here. They're giving us some information. Prepare a multi-step income statement, okay? Now, we learned that the comprehensive income is going to be put up at the top. So let's see what we have here. Well, do we have sales? I see other revenues. So we have revenues, 462, minus cost of goods sold. That's going to give us our gross profit, right? And they don't give us an example of it. Oh, for heaven's sake, they don't give us the solution, which takes the wind out of my sails. But let's talk our way through it briefly. You have sales of 462 minus cost of goods sold. That's going to equal what? Your gross profit. And then we're going to subtract from that the operating expenses to get down to operating income. And then we're going to take out other expenses and losses, other revenues and gains, other comprehensive. And I skipped over sales discounts. That would have come up after revenue. I hate when they give you a problem to demonstrate, they don't give you the template. Prepare a comprehensive income statement, 25%. Yeah, sure. Now we're getting into a different system, Liba. This is not a good system. This is an old-fashioned periodic system. What you're going to learn here is that you do not record the cost of goods sold with each sale. You don't have the ability to do it. So you have to wait until the end of the year and count how much you have in the inventory. And kind of what you don't have is what your cost of goods sold was. So let's see what we're talking about. Under a periodic system, no running charges in inventory are maintained. Ending inventory is only determined by physical count. So every month you have to go out and count the inventory. How come? Well, we're going to take the beginning inventory or the inventory at the end of last month, plus what was purchased. That gives us cost of goods available for sale. That's your 100% line right there. Cost of goods available for sale. At the end of the month, we either sold the goods or we still have them. We go out and we count and we find out we had so much left in inventory. And when we subtract out, we come up with the cost of goods sold. And they're showing you the income statement. What's different here is they're showing you purchase returns and allowances and purchase discounts. Freight in becomes freight in. It's part of the, it doesn't become inventory like under the perpetual. It's fairly similar though. Cost of goods sold. Yeah, let me demonstrate it another way. We have cost of goods sold of 36,000 plus your net purchases, meaning purchases less returns and discounts and allowances, less freight. There's your cost of goods purchased. Add them up to get cost of goods available for sale and then subtract. Under the periodic, you must do this every month. You do not have a choice. Aerosmith's company's accounting records show the following at the end of the year. Assume that they use the periodic system. Let's do the cost of goods purchased and the cost of goods sold. Well, the cost of goods purchased is going to be the purchases for the month minus the purchase discounts and the purchase returns. And again, they don't give us the answer, but let's talk about it. You have purchases of 162.5 minus purchase discounts minus purchase returns and allowances, okay? That will give you net purchases. So we set that number aside. We're going to take the beginning inventory plus the net purchases plus the freight in and subtract the ending inventory. I can't explain it any more clear than that, Liba. But it's not that hard once you do a few of the short problems on the homework. Analyze gross profit rate and profit margin. Okay, this is pretty easy stuff here. Many of the metrics that business people look at are based on a percentage of the sales, okay? So let's see what we have here. Look at your first metric. This will be on the test for sure. Gross profit rate. If you take the gross profit dollars, divide by the net sales, you're going to come up with a percentage, and that percentage is going to be called the gross profit rate. And it can vary from different types of businesses. Some have a very low gross profit, others have very high. It's all about the nature of the product. So there's your first metric. Profit margin. We're going to do the same thing, except we're going to do it with the net income. So take a look here. Your net income was 38,275. Remember that famous number? We're using the same numbers. Remember the 2557? Your net income was 38,275 divided by 2557. They did 1.5%. Last year it was 1.5%. And compared to a competitor, they're only doing half as well. And why would a rate go down? The amount of operating expenses relative to sales may have changed. Could be a lot of reasons why. But two metrics now. Gross profit divided by net sales. Net income divided by net sales. Net sales are always considered 100%. Uh-oh, you got a pencil ready, Liba?
Yes.
Why don't you tell me the gross profit rate here? How do we get the gross profit rate? We divide what by what?
For 2022, it would be net sales minus the cost of goods and services. So 80,000 minus 40,000 divided by 80,000, which would be 50%.
Perfect. Perfect. And it's the same on the next one. We both, I think, 50%.
Yeah, it would be 50% for
Yeah,
2021.
so that's not too tough. I asked you for the gross profit. They were actually asking for the profit margin. How would you do that?
Oh, for the profit margin, it would be 80,000 for 2022. 18,000 divided by 80,000, which
There
would
you
be
go. Excellent.
22.5.
Yep. Excellent. You got it. Record purchases and sales of inventory under a periodic system. This gets a little complicated here when we start talking about the different subtleties of journal entries. You record revenues when the sales are made, blah, 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 has nothing to do with the sale. Record purchases. Now, under the perpetual system, we debited inventory, didn't we, Liba, for everything we purchased? Under this method, we're debiting purchases because there is no real inventory because we don't know what it is. So we're going to use the word purchases. Purchases is a cost. Inventory is an asset. So we're going to be recording these costs every month. We purchased something for $3,500. The cost of the item was $2,400. So there's our purchase right there. How come, here's the question, Liba, how come they didn't record the $2,400 cost of goods sold? Got any idea?
No.
Because you don't record the cost of goods sold under this method, periodic. That's the whole point of the periodic method. You don't do anything with the cost of goods sold. You only can calculate it at the end of the month when you count your inventory. Freight costs, freight, cash. Somebody returns something. Well, somebody returns something, that means they're not going to have to pay that $300. We debit accounts payable and we credit purchase returns. Here you go, Sock Studio paid the balance. So Sock owes $3,500. They only had to pay $3,430. 70 is the discount, 3,500 is the amount of debt they settled. Okay. Again, they're showing you a sale under the periodic method, emphasizing that you don't even look at the cost of goods sold. Then another return. They repeated those transactions. But I would take a look at this screen here and try to get a little bit familiar with it, okay?
Okay.
To the left, you have transactions, and then to the right, the two systems. Purchases of merchandise on credit. Notice in the perpetual inventory system, you're using the word inventory, right? Inventory. I see the word
Yes.
inventory 1, 2, 3 times. I see the word inventory in each of the blue transactions. Go to the red, which is the periodic. Inventory becomes what word?
Right in.
You have inventory on for 3,800 in blue, right?
Yes. Oh,
Go to the right.
purchases.
You called, yeah, good. You got it. They're called purchases. So wherever you see the word inventory under a perpetual system, it becomes purchases under the periodic system. Inventory is where freight goes under perpetual. You just use freight there. So just something to look at, because on the exam, they'll give you a question. They'll say Johnson Company sold $300 worth of goods that cost them $100 to a customer. Record the journal entry under a periodic method. Well, you would have to know then that you only have 2 lines to do. If it was under perpetual, you'd have 4 lines. You'd have to debit accounts receivable, credit sales, debit cost of goods sold, credit inventory. So there's quite a lot in this chapter here. Nothing terribly onerous, but it's a bit lengthy. Here's some more. Look at the entry on May 4th, Live. You see that first entry there?
Yes.
Perpetual inventory system. Debit receivables, credit sales, right? Under the perpetual, though, we have to record the cost of goods sold of 2,400 and the reduction of the inventory. Under the other one, we don't. That's probably the main difference between the two. Okay.
Okay.
Okay, now here on Appendix 5B, I think I'm going to stop. And the reason is, I think our faculty decided that we weren't going to go over this particular area. It's kind of an oddball area. But if I hear from Cornelia that I'm supposed to teach it, we'll go into it, okay? So we'll skip that. And now we're into international, which we know we don't cover. Ergo, that's the end of our lesson today, okay, Liba?
Okay.
Any questions, any comments?
No. Well, this is a lot more complex than previously, so it'll take a lot more steps, but I'll try to practice it over the weekend to get
Yeah,
better.
you do good. What kind of questions gave you trouble on the test?
It was calculating like the total liability,
Yeah, I can
that
imagine.
question. total
Yeah.
stock equity.
Oh, yeah.
Because when it said like the assets increased and then,
Oh, we didn't go over any particular question like that. Those are so easy to do. And I could have shown you a shortcut. Yeah, in other words, they gave you the assets and say the liabilities. And then they wanted you know what, say the liabilities were in the second year, right?
yeah, one of them was like the resources was this, and then the assets
Yeah,
increased. I don't remember the exact wording. I think it
yeah,
asked for like liability. That's the one I had trouble in, but the other one, this total equity one, I figured that one out.
yeah. I'm good to hear you did very well. All right, so we'll call it a day, okay, Liva?
Okay, thank you
And
so much. Have a
we'll
good
see you
rest of
on
your day.
Tuesday. You're welcome. Hey, bye-bye.
Bye.